All right, hello and welcome. With the new Income Tax Act of 2025 just around the corner, we're all gearing up for some big shifts. So today, we're going to zero in on something absolutely critical for the financial sector, Section 118. We'll be looking at what it means for cooperative banks when they go through a business reorganization. Let's dive right in. So let me ask you something. Picture this. Your client, a cooperative bank, is about to merge with another one. Now, they've got some pretty hefty business losses and unabsorbed depreciation sitting on their books. So what happens? Does all that value just poof, disappear after the merger? I mean, for you and your client, getting the answer to that question right is a pretty big deal.
Well, the good news is the new act doesn't leave us hanging. It gives us a really clear path. And that answer? It's found right in Section 118. This is the section that really dictates the fate of those losses. And, getting a grip on it is absolutely key if you want to advise your clients properly. Okay, so here's our game plan for this explainer. We'll kick things off by introducing Section 118, then we'll walk through the key conditions, look at a practical example, cover the all-important compliance and common pitfalls, and then we'll wrap it all up with the main takeaways. Sound good?
All right, let's get into the meat of it. What is Section 118? Well, at its core, it's all about ensuring that business losses can continue on when a cooperative bank reorganizes itself, through something like an amalgamation or a demerger. It's really there to provide some stability and a predictable tax outcome. And it's super important to understand why this law exists. The intent behind it isn't just about collecting taxes. It's really about making it easier for the cooperative banking sector to restructure when it needs to. Think about it. By letting those losses carry over, the law creates what we call tax neutrality. It makes sure that a merger doesn't unfairly punish a bank. And big picture, it helps promote a healthier, more stable financial system for everyone. Now, if you've been in the game for a while and you're familiar with the old 1961 Act, this idea might ring a bell. We had provisions like Section 72 AB that kind of did a similar job. So what Section 118 is doing is taking those old rules, consolidating them, clarifying them, and bringing them forward into the new 2025 framework. The key thing to remember is this. The section number might be new, but that core principle of saving genuine losses during a reorg, that continues.
Okay, so let's get down to the nitty-gritty. A bank can't just merge and expect to automatically claim these losses. Nope. There are very specific conditions that have to be met. You can think of these as the rules of the game, and you've got to know them inside and out. First up, let's tackle a key term right out of the Act itself, unabsorbed depreciation. So what does it mean? Well, the law defines it as the depreciation allowance that the original bank, the one being merged, would have been able to claim if the merger had never even happened. Section 118 basically allows this potential deduction to be passed right on to the new successor bank. So what are these all-important conditions? It really boils down to four main things. 1, you need a valid, legitimate business reorganization. 2, the original bank has to have those losses or that unabsorbed depreciation to begin with. 3, and listen up, this one is critical. The new bank must continue the business of the old bank. And 4, there will be other specific conditions, probably spelled out in the income tax rules of 2026, about things like asset transfers, and those have to be met too. Okay, theory is great, but let's see how this actually plays out in the real world. A simple example can make the financial impact of Section 118 crystal clear for you and your clients. All right, here's the scenario. We have Bank A, that's our amalgamating bank, and it's carrying a business loss of 5 crore rupees. It's merging into Bank B. Now, in that first year after the merger, the new combined bank, Bank B, goes on to make a profit of 8 crore rupees. Simple enough, right? So how does Section 118 kick in here? Well, it's actually pretty straightforward. We take that 8 crore profit that Bank B made, and now, thanks to this section, we can subtract the entire 5 crore loss that was brought forward from Bank A. This directly slashes the amount of income that's actually taxable. And that brings us to the bottom line. Suddenly, the taxable income for Bank B isn't 8 crore, it's just 3 crore. I mean, that's a direct tax saving on 5 crore of income. It's a massive, massive benefit that would have been completely lost without Section 118. But, and this is a big but, getting this benefit isn't automatic. It really demands careful attention to detail. So let's switch gears and talk about the professional playbook, what you actually need to do to stay compliant, and maybe more importantly, what common mistakes you absolutely have to avoid. Okay, here's a quick checklist for you. First off, documentation is king. You need meticulous records of the whole organization scheme. Second, you have to compute and report those losses with total accuracy on the tax returns. Third, you've got to keep your eyes peeled for any specific forms that the upcoming income tax rules of 2026 might require. And finally, remember this isn't a one-and-done thing. You have to keep monitoring to make sure those business continuity conditions are being met even after the merger.
And on the flip side, here are the traps you need to dodge. The biggest one, pretty obviously, is if the new bank just stops running the old bank's main business. That's a surefire way to lose the benefit. Another one is failing to hold on to the required assets after the merger. And here's a really crucial point coming from transitional provisions. The original loss claim had to be valid in the first place. So if a loss return was filed late under the old 1961 Act, you can't just revive it now under the new Act. And if you're dealing with a demerger, not a full merger, make sure those losses are split up correctly.
Phew, okay, we've covered a ton of ground here. So let's pull it all together and just quickly summarize the absolute most important things you need to walk away with about Section 118. So what are the big takeaways? Number one, Section 118 is the vital go-to provision for any cooperative bank going through a merger or demerger. Number two, its main job is to let the new bank use the old bank's losses to offset its own profits. Number three, remember, this is not a free pass. The benefit is completely conditional on sticking to those strict business continuity rules. And finally, number four, for you as a professional, being proactive with compliance and keeping perfect documentation, that is what will make or break this for your client. Just a quick but important note, this explainer is purely for educational purposes and should not be taken as professional advice. Tax laws can and do change, so it's always best to consult with your own professional advisor before making any decisions.
This is an AI-generated educational video.
Thank you so much for watching. If you found this breakdown helpful, we'd really appreciate it if you'd like, subscribe, and maybe share it with your colleagues. We'll see you in the next one.